Gross profit margin measures how much profit a business makes after covering its direct costs. These direct costs are what we call cost of sales or cost of goods sold. So essentially, gross profit margin tells us, out of every pound of sales, how much is left after paying for the cost of producing the goods? Now let's look at the formula. First, we calculate gross profit, revenue minus cost of sales. Then we turn that into a percentage. Gross profit margin equals gross profit divided by revenue multiplied by 100. Let's go through a simple example. Imagine a company has revenue of £100,000 and cost of sales of £60,000. So the gross profit is £40,000. Now we apply the formula. 40,000 divided by 100,000 times 100 gives us a gross profit margin of 40%. What does this mean? It means for every £1 of sales, the company keeps 40 pence after covering direct costs. Gross profit margin means nothing on its own. We must compare it. Let's say Company A has a margin of 40% and Company B has a margin of 20%. Clearly, Company A is performing better. It could be higher selling prices, lower costs, or better efficiency. Different industries have different margins. For example, supermarkets operate on very low margins. Luxury brands have very high margins. Manufacturing businesses are somewhere in the middle. Gross profit margin should always be compared with competitors operating in the same industry, as different industries have very different cost structures and pricing strategies. The gross profit margin increased from 20% to 40%, indicating improved cost control or higher pricing. This may be due to better supplier negotiation or a shift toward higher margin products. Strong businesses protect and improve their margins. It's what gives you room to grow, pay expenses, and make real profit.